Samir Africa posted an 8% rise in full-year group turnover to 3.96 billion shillings. The increase attributed to growth in sales to existing and new export markets. The tyre producer saw profit after tax grow by 96% to 190 million shillings. Allan Walmsley, who's the MD of Samir Africa, joins us for more. Good morning to you, Allan, and perhaps we could just start. I always like to look at the revenue, just the big picture numbers, the revenue and the profit, and when your turnover grows by a number and the profit grows by more than that, you're generally doing something right. Turnover up by 8% to 3.96 Kenyan shillings. You talk about profit going up by pre-tax profit up by 100% over 2011. So what's behind those numbers?
Look, we were very fortunate. On a year-on-year comparison basis, we saved a lot in terms of our finance costs. We focused a lot on our working capital. But we were also fortunate from the point of view that 2011 was a very bad year from the point, specifically with exchange losses, which we were able to avoid in 2012. A far more stable shilling helped us out there.
Well, let's look at your operational side. Take away that currency effect. What sort of operational year was it for you?
It was actually very good for us. We were able to reverse a very adverse trend as far as our factory production was concerned. And for the first time in about 3 years, we were able to increase our volumes in the factory. As far as cost control was concerned, we were very fortunate. We kept a very close hold on cost increases. But I think a very big kicker came as far as the international commodity markets were concerned. We were able to source rubber, synthetic rubber, at very much reduced prices versus the previous year. In fact, on a basket comparison basis, our raw material inputs decreased by 10%.
If you look at the market that you're operating into, you obviously you're exporting and you're doing for your own market. How is that market going? Because we're looking at growth generally in Africa of 5-6%. That's the kind of numbers that a lot of those countries, and East Africa certainly has that kind of growth prospect. How does that translate into your business? Does demand increase exactly in line with that growth that's happening?
There's a very strong correlation. There's no question. However, what we are seeing in Africa is very stiff competition from cheap imported tires. So whilst, and in fact in the last 4 years, Asian tire manufacturers have grown their market share from 30 to about 46% currently. So yes, the demand does wash through, there's no question. It comes through almost on a direct correlation basis, but we are seeing our traditional markets being penetrated by these cheap tires.
What about the regulators when it comes to cheap imports? Of course, many companies go squealing to the legislators and the regulators, and they say, people are dumping tires on us. In South Africa, we have an issue with dumped chicken, for example, and the companies are saying, if you don't protect us from these dumped chickens from South America, we could go out of business. The industry could go out of business. So yes. If you're saying that the prices are so much lower, are there appeals to the regulators, or are they staying out of it?
No. I think. Look, through our various trade bodies, we make very strong representations, and it's a topic that's always on the table when we engage with government. So we keep pushing. It's just something that we have to keep in view as far as government is concerned and as far as the regulators are concerned.
Something else that caught my eye in your results was your talk about introducing solar energy and coal-fired boiler alternatives in your production process. That sounds promising.
No, it is. You see, our energy costs is actually our single largest cost component. Now, we're very fortunate where the factory is located. It lends itself almost perfectly to the introduction of solar power, so that is something we're looking very aggressively at. And coal, yes, it will definitely reduce our production costs. And we're really looking to push the button on that in 2014.
Well, Alan, there are a lot of things that you can control, but also a lot that you can't. As your results statement indicates, you've got imports, you've got currency issues, you've got commodities moving. This time next year, where will you be looking for the results of the company?
I think the view that we have is that for the first 3 quarters of this year, 2013, we're very bullish as far as our imported our basket of imported goods is concerned. We see a lot of stability there. We're a little bit concerned about the 4th quarter. I think we are going to see natural rubber prices increase there. But our biggest concern at the moment is, in fact, the stability of the Kenya shilling. Our concern basically is the trade deficit, which is increasing, basically because of the increase in imports of capital equipment into Kenya itself. So that's our biggest concern at the moment. Not so much the commodity market, more the Kenya shilling at this point.